Robert Marson and Bob Morris, and here to talk ideas of the day, stocks of the day. Robert hasn't told me what he's going to talk about, so it'll be a surprise. I think he's got 2 small caps for us today.
Yeah, updates on a couple of names. As I told Berna earlier, you have a yin and yang situation here. We have in the growth manager's mind, there's been only, up until last week, there was only one trade. It was the AI trade, and that was populated with power and semiconductors and infrastructure and Caterpillar tractor because they make diesel generators, maybe some small turbines, nonsense like that, getting to stupid valuations. And as that trade has come off in the last week, and for our subscribers, you should read my comments about semiconductors just last week. I used the effing word in it. It was the valuations are so crazy or stupid, as I call them. And I own 2 semiconductor stocks, by the way. So I'm going along with the party like everyone else. But now that this data center trade and especially the semiconductor trade is rolled over, there's the growth managers need a new growth industry to rotate into, and it's been healthcare. And I happen to have one of those stocks, and that company is called KORU Medical, KRMD, and it's my subcutaneous pump company, and it's gotten cheap for a healthcare company with low to mid 20% revenue growth and mid to high 60% gross margins on a little more scale. It's a small company. They did 41 million in revenues last year. We're going to do 50. I have them doing 51 this year and 64 million next year. So this is not a big business, but it's only the first or second inning of subcutaneous drug delivery. So there's a massive shift from IV delivery to subcutaneous delivery because it's just easier. You can do it at home. It's easy to do in the clinic. In a infusion clinic, one nurse can oversee 4 or 5 of these, and they get done in like a third of the time of an IV. So the throughput at the infusion clinic could be double, at least, if not triple IVs. It's just a great little, company, and they have a leading share in this business because it's, it has been a small niche. But major drug companies seeing this are actually developing some of these liquid drugs for subcutaneous before they do the IV version, which is a major change in how drug companies go to market. So this company makes the pump, they make the delivery system, the tubing and the needles, which are consumables. So 75% of their business, 80% of their business is consumables. It's just a great little niche story. And it's been overwhelmed by everyone piling into the data center trade, in my opinion. So the stock, which we bought here a couple of years ago at 2 and change, 230, 240, got up to 6.5 last year. And then when the data center trade, hit, this thing pooped out and went down to about $3.90, $4. So in my opinion, the visibility to 25% growth as a stretch goal is reasonable. So that's what I'm using. And that makes this stock under 3 times EV to sales. Now, they're not very, profitable because they're in their, strong growth phase. So they have a lot of submissions and tests and new markets they're opening up with SG&A. But, they want to get to $100 million in revenues in a few years from 40 million last year. And if they do that, this business should be at least worth 5 times sales to Becton Dickinson or somebody like that. So it's just it's a great little business. It's starting to get some attention now because growth managers, they want to rotate out of their semiconductor stocks. And therefore, this is a phenomenal candidate for the small cap growth portfolio manager.
You think these guys are self-funding, or is there any chance that they're going to need to raise capital? Because only have like $9 million of cash on the
Yeah,
balance sheet.
they are self-funding now. Now, if the stock got, priced like a semiconductor company, right? 10 times sales, 15 times sales, I'm sure somewhere in between they would sell stock, right? Just because it was, too expensive or too cheap to pass up to sell stock. But now at these valuations, there's no way they're going to sell equity, and they're self-funding.
Got it. And who do they compete with?
Really, it's such a small niche. Nobody. There's a couple of private companies that make different kind of pumps. They have an old-fashioned pump that is, you crank it up and it's gravity and crank powered, right? So for people doing this, there's no electronics to deal with, and it's just it's a relatively simple device, but they have a lot of patents on it, and they're introducing newer products. But right now, the niche, might have been 5 years ago thought of as $100 million business, Berna. So nobody wants to go after that TAM. It's probably up to triple that by now, and growing pretty rapidly. It's growing double digits just organically, and that's without any price increases. So there's just a lot of unit growth, and the rest of the world is way under penetrated relative to the U.S. And their new story now is, now that they got the U.S. covered, they're just expanding in Europe and Japan and the other developed markets.
Cool. Well, that sounds like a neat little company, kind of definitely off the radar screen. Does this one even have any? Does this one even have any sell side coverage?
If you look it up on Bloomberg, they have like 4 legitimate second and third tier analyst coverage. Yeah, it's actually pretty good. So this is my version of a compounder. Okay. And compounders is a word that I mock a lot because it's a reason for people to hold stupidly priced businesses that have had massive runs after modest growth spurts, And one I debated someone here on this a long time ago was Pool, P-O-O-L. Oh, just put it away. It's a compounder. Bullshit. It's a shitty roll-up company, okay? With no, they have a lot of scale, but they don't have anything proprietary in my mind. That, and you remember Lulu was a compounder and Starbucks was a compounder. You would just set it and forget it, right? Well, my version of this is this company, which should, it's not like we got in cheap. I like to get in these things when they break at 1, 1.5, 2 times sales. Maybe I was at 2 and change. It was 1.3, 1.75. It was relatively cheap for what it was. But you have to digest 2 years of growth to get cheap, and then it grows 25. So when they're $100 million growing 25%, they'll put on 25 million more in revenue, which 2 years ago was their whole year. So I want to own this for 10 years. I don't want to own this for 10 months or 10 quarters. And when it went to 660, I told myself this is expensive, and I know I'm going to take a correction on this, a drawdown. And I did, and I'm happy because I want to own this for 5 to 10 years.
Or maybe someone will take it from you before 5 to 10 years.
There's a couple of very large shareholders, and my fear is that they do that.
Well, that's an interesting one. Did you say you had a second one today?
Well, that was the yin. The yang, obviously, is a semiconductor stock, right? Because when the medical's working, the semis are not, and vice versa. So I actually own a semiconductor stock that's cheap. Now you say, what? There are no cheap semis. I know semis, Vernon. There are no cheap semiconductors except my stock. And you've heard this name before. I haven't talked about it in a while because it tripled for me since I bought it in January and December, January of this year. So it's Intest, INTT, and it's that's also a $200 million market cap with 10 million in cash. The enterprise value 190. They'll be 180 by the end of the year because they'll produce 10 million more cash between now and the end of the year. And they're budgeted for 135 million in revenue this year and 155 next year if they grow 15%. Now, here's the issue with Intest. They're late cycle for CapEx. They're not very big in DRAM and memory and logic, which are GPUs, CPUs, and memory. They're in everything else. That's called analog. That's called mixed signal. That means power semiconductors and sensors and things that measure real phenomena in the world, sound and light and temperature, moisture, that kind of stuff. So they sell tools that make those subsystems in tools that make those products for in-test. So it got to 20. It's pulled back to 14 and change in the semiconductor correction. And it's only about half semi. The other half is mostly electronics, like circuit boards and battery testing platforms. It's all tied to the electronic marketplace, which is still a boom area in the U.S. as we onshore electronics manufacturing and semiconductor manufacturing. It's a play there. But it's only 1.15 times revenues. It's a stinky one-time sales for a primary, the main end market at 50% of the business in the normal part of the cycle is semiconductors. The other 50% are end markets that are all electronics related. So they don't do non-electronic stuff, but there's not 100% end market of semiconductors. They sell in defense and aerospace. They sell into automotive. They sell into general manufacturing. Wherever there's people manufacturing circuit boards for inclusion into any electronic device, they sell equipment to test those things. So it's a good little company. They have high gross margins. And if they're making 155 next year, according to my model, they'll make $1.25 in earnings. Now, I didn't buy the stock today at 14 and change. If I didn't own stock, I would nibble. I bought my last stock. I bought it at 6. I bought it at 8. I have a $7.11 average basis. So just like the convenience store,
So did you take any off the table when it ran like this? Not at all.
I did not touch a share at 20. No. Nope. A good chunk of it was, most of it was short term, when it went to 20 earlier this year. But, I still think if they do $1.25 next year, this is just their cycle is just starting, and they're usually 2 to 3 years at least. So I think they could, in 3 years, make $2, trade at 20 times earnings, and I'd have a $40 stock. They actually have competitors today. KORU, Amtech Systems, these are other small capital equipment companies. KORU is a big customer for them, and they trade at like 4 and 5 times sales right now, even after the correction. So I'm at 1 time sales. They have peers at 3, 4, 5 times sales. So I'm very willing to sit on I'm very willing to add to a position, probably 12 and a half, definitely 13 and a half. I would probably buy more, and it's 14 3/4 right now. It's not, and remember, I have a $7 cost basis. So I'm still paying nearly double of what my original cost was for the company. But I would definitely be a buyer in the 12 and 13 range, which is only a point or two away, and could get there in another bad semiconductor day this week. Tomorrow, it could go there. These things are in such rebound. So you have both sides of the trade. When semis work, we have in-test. It'll go back to 20. When semis don't work, we have KORU Medical, because it's a high-growth medical company, and there's not a lot of organic 25% medical tech or medical device or drug companies out there. It is a unicorn in the medical industry, in the stock market. So,
well, that's an interesting yin yang and good subsector balance. And the way things are going today, looks like another down semi day. So who knows?
It should be up. KRMD should be up, right?
Yeah. Sounds good. These are both interesting ideas. I'm going to look into both of them myself. But for now, let's move on to Bob and what you're looking at in the oil patch today.
Yes, thanks. So, there continue to be these crosswinds on oil prices. Oil was weighed on a little bit earlier this week when OPEC on Sunday announced that they would increase quotas for the third consecutive month, this time beginning in August. But then this morning, apparently the IRGC attacked a commercial vessel in the Strait of Hormuz, and that's why oil's up $1.50 at around $70 a barrel. So, these crosswinds on oil prices continue to move it, but it's sitting in here around $70 a barrel. We said last week we didn't see a lot of downside to oil at around $70 a barrel. I still think that's true. I think the risk is probably skewed maybe slightly more to the upside if there is any disruption in further disruption in the Strait of Hormuz, and depending on how these negotiations under the MOU proceed over the next 60 days, which are on hold currently for the funeral procession of Khomeini in Iran and Qatar. So we'll see how those resume and if they're able to get to an agreement. I think the Trump administration does desperately want to reach a deal, and especially ahead of the midterms, as we get closer to the midterms, he sort of, in my view, wants to put this to bed. And he's gotten oil or energy prices down, and he wants to keep those down here. And even further as some of these inventories roll through and prices continue to drop at the pump. So, we'd said last week too that we thought the oil levered names on average reflected around $65, $70 oil in here. So I'm not changing any of my positions. Yes, some of these oil names have pulled back from their highs when oil was at $100 a barrel. But, the ones that I do like, the C&Qs, the Chevrons, the EOGs, I'd hold on to them here at these levels. And we've got earnings coming up. They start to kick off in a couple of weeks. And I think estimates currently with where consensus is have to come up because they don't fully reflect yet the realizations on oil prices during the quarter and what a lot of these companies have locked in hedging wise going forward. So I'm not selling anything here. Don't want to sell at these oil prices. In the meantime, we're watching these natural gas names, which has been a little bit more interesting, and that natural gas has continued to hug in here around 320, 330. And we've got storage inventories almost where they were a year ago. And we had this heat dome across much of the U.S., which really didn't give a lift to natural gas prices. I think a lot of that because everything was already running at full capacity on natural gas-fired power as it was. But now we've got talk about this super El Nino, which has come to the forefront. And that's raised a little bit of concern. And that if we do get this super El Nino, it portends milder winter temperatures. And that's always the biggest risk to natural gas prices, despite the longer-term fundamentals on increased demand from data centers and industrial production growth and LNG exports. If you get a mild winter, that sort of puts everything on hold for another year and keeps these prices down with a 3 handle on average for a year if that were to play out. So I think that's put a little bit of concern into some of the natural gas names. The Expand Energies, the EQTs we like and hold have been a little bit weak in here with where natural gas prices are. I still like those names. If you don't own any natural gas exposed names, I'd be looking to nibble on these on any, weakness or further pullback, although they have pulled back here. But those are names that I continue to like, but I've never been one to be able to, or anybody has to accurately forecast the weather. But I think that's sort of, for now is a bit of an overhang with storage levels for natural gas close to year ago levels. With this concern now of a super El Nino and mild winter temperatures, we're sort of waiting and watching for the demand uptick from what I mentioned before, the data centers, the industrial demand, LNG, and all that. But I still, from a longer-term fundamental perspective, like the natural gas names and continue to hold on to my favorite oil names here.
Great.
Super El Nino. We haven't heard Super El Nino in a long time. We've heard El Nino and La Nina. And typically, when you hear La Nina or El Nino, unless it's a strong version of either one, it really is not a good predictor of weather patterns. But this time, it's supposedly a Super El Nino, which they give I think 63% chance of developing, which then would be a very strong weather pattern in that regard. So it's something worth keeping an eye on, although we got a ways to go before we know if that's going to play out or not. But I think it's been, I can't remember last time I heard a super El Nino.
And if it does, it's what, warmer and wetter? Is that the
Yes, some droughts in the south, and then, but yeah, milder winter temperatures in the northeast, which is where it counts the most.
Nothing like trying to predict the weather next January when you're sitting in the middle of July. But I'm sure somewhere there's a weather trader doing some derivative of something.
Oh yeah, oh yeah, playing corn futures or something too. So yeah.
Exactly. Well,
I got a question for you, Perna. I know
yeah, go ahead.
you're the moderator. You didn't come armed with a stock, but how's the consumer doing in apparel and shoes? Since we own a couple of those things in general.
I would say shockingly resilient is the takeaway so far. Because, the only companies that are really harping on about the consumer being weak are ones that are looking for excuses, because there are plenty of companies that have held up well, and across apparel, footwear, but also restaurants, like and, this move down in gas prices, I think, just gives yet another leg to that, so, I think that so far so good. It's still a very dominant K economy, with most of the spending and all the advertising, directing at sort of like the top 25% of households, top 20% of households. So there's that pattern effect, but I think that we expected to see the bottom fall out a lot more in the run up in gas prices, and it just didn't happen. I mean, I'm sure if Charlie was here, he would have comments about credit usage and how stretched the consumer is. The consumer is probably leaning harder on credit than they were a year or two ago. But so far, the bottom really has not fallen out of the consumer economy in any way. Within apparel and footwear, it remains, as always, it's like it's a share game. This isn't a sector where overall it's going to grow 10-15%, but within that, we're seeing, you're seeing just massive dispersion as always. So, if On can grow, 20% or 15% in the US while Nike's shrinking, that's about share. That's not about the pie, but the pie is holding steady and growing slowly. So far so good. I think I'm surprised. I have to say, I thought that, we would see more of a pullback in spending, but, well, it'll be an important, period coming up, because, we're about 2 weeks from back to school starting in earnest. So, which is an important time of year. But I think, people are cautiously optimistic about it.
Thank you.
So.
All right. Well.
Okay. Well, if nobody has anything else, we'll just keep it a little bit of a shorter, tighter show today. But thanks so much for joining us. And we'll be back tomorrow with more ideas. And come check us out online at wallstreetbeats.com.
Thanks,
Bob. Thanks, Robert.
Thanks, Marie.